What are futures? Well, it's a critical concept for anyone studying finance, economics, or anyone that wants to day trade full time or part time. In this video, we're going to explain what a futures contract is. We're going to go over some historical facts, some things that actually happened, and it's interesting to know. And we're also going to explain why trade futures. What are the advantages of trading futures? So even if you already know what futures are and what a futures contract is, make sure you watch till the end of this video because you're going to learn something in this video. There's a lot of different facts and information in this video that you're going to find interesting, and I guarantee you're going to learn something. So let's go ahead and get into it. So we're going to keep it simple, and then we're going to build on top of this. So what is a futures contract? Well, basically, when a buyer and a seller want to make a transaction in the future, they can create a futures contract. So what they're doing it is at a fixed price and at a fixed date in the future. So for example, a farmer agrees to sell one cow for $3,000 to a buyer on May 1st, 2025. So they both sit down and then they agree on the price and the date for when they're going to make that transaction. And that is a futures contract. Now it gets more complicated, but let's start with how it started. Futures really started in the agricultural industry and became popular in the 1800s. And the Chicago Board of Trade standardized futures in 1864. So how did the futures arise? Well, farmers plant crops now, but they don't know what that price is going to be, in a year from now when those plants actually grow and they can harvest them. So they have that risk. They don't know what the price is going to be. What if the price drops when it comes time to harvest? So to avoid that risk, they sell a futures contract to lock in a fixed price and a fixed date. This is an advantage to the buyer as well because they avoid the risk of having to buy at higher prices. So let's say someone uses grains and they make something out of grain. Well, they're at risk of those prices being higher when they want to buy it in the future. So both the seller and the buyer get this advantage by reducing price risk. The only downside is that they limit their upside potential. So, right, if we're a farmer, there's a chance that this grain that we're selling in a year, the price could shoot way up, and that'd be great for us. However, we also have that risk of the price going down in the future. So both parties gain this advantage. They reduce their downside risk by limiting their upside potential. This was even earlier than the Chicago Board of Trade. The first real standardized example was the Dojima Rice Exchange. And this was formed in 1697 in Japan. And if you're familiar with futures or trading in any way, then doji is a form of a candlestick. So, it's interesting to see where that doji word actually came from. So from agriculture, futures spread into all types of markets. So other than just like grains, we also have went into animals like cattle and hogs. Also went into metal, so gold, silver, copper, platinum. Other commodities like oil and cotton. And then these futures became more advanced. So now you can even trade futures on currencies. So you can trade them on the euro, the pound, the Japanese yen, the Canadian dollar. So you can trade futures on financial markets. They became even more advanced where we can trade them on indices. So if you're familiar with the S&P 500 or the NASDAQ, you can actually trade futures on those. So futures just continued to advance into and now we have our modern financial markets. Let's learn a couple words. The underlying is the asset being transacted at a future date. So when we're talking about gold and gold futures, gold is the underlying. That's the actual product that is being moved. It's being traded in the future. The derivative is the investment vehicle we're using to take that bet. So the gold is the underlying, and the gold futures is the derivative. And you'll see these words outside of just futures as well. So derivative is basically any time there's a vehicle being used to trade something else. So the derivative derives its value from whatever the underlying is doing. I have some examples here. Underlying 50,000 pounds of cattle. And that is what goes under one cattle futures contract. For the gold futures contract, that would be 100 troy ounces of gold. And the S&P 500 index, if you want to trade futures on the S&P 500, that is called the E-mini. That's just the name for the contract. So 50 times the S&P 500 index, that is equal to one E-mini contract. And we're going to continue to explain this as we go on. So who trades futures contracts? Well, there's two types of people. The first are hedgers. So they already have a position in the underlying and they want to avoid price risk. So you could look at the examples we were using with the farmers earlier. Another good example is, let's say you're an oil producer, and the oil producers, they have to sell at least a minimum price to stay profitable. So what they'll do is they'll sell a futures contract on oil, and this is called taking a short position. If the price of oil goes down, well, they're going to make money by shorting that futures contract, and that money they made will offset the lower prices that they're selling their oil for. Another example, we think about airlines, right? Airlines have a risk of the jet fuel that goes into the planes. If the price of that jet fuel goes up, they're going to start losing money. So what they could do is they could buy oil futures contracts. So that way, if the price of oil and fuel goes up, well, they're going to make money on the futures contract, and that will offset whatever extra expenses they have from the jet fuel. There are also speculators, and these are people who enter and exit positions for a profit. So it doesn't matter to them what's going on with the underlying or what the underlying is. They're just there to make money from price moves. So an example, as a day trader thinks the price of gold will go up. Instead of buying physical gold, they buy a futures contract for $2,600 and sell it at $2,800. So they never actually took on any gold. They just owned this futures contract for a little bit, and they sold it at a higher price than what they bought it for. So what happens on the expiration date? And the expiration date is that agreed upon date when the futures contract ends and the two parties transact. There's two things that happen. One is the physical delivery. And this is basically the two parties transact what they agreed that they would transact. So, if it's cattle futures, one person hands over the cattle and the other person pays them for the cattle. The more common form today is called cash settlement. So one party pays the other cash based on the difference in price from what the initial agreed upon price is. So look at an example. Say you buy gold futures at $2,500. On the expiration date, it's now at $2,600. And if it's cash settled, the seller just pays you that difference. They just give you $100. Now, what is the alternative to this? Why is cash settlement better than physical delivery? Well, if you're the seller of this contract, you have to actually get gold to be able to sell it to the buyer. So the seller goes into the market, they buy it at $2,600, they sell it to the buyer for $2,500. Now the buyer has this gold at $2,500 that they bought at $2,500, and then they don't actually want to hold the gold, so they have to go to the market and sell it at $2,600. So there's all these extra steps involved, all these extra costs, and it's better to just cash settle. So that's why most transactions in futures now are just cash settled. So your broker pretty much will never allow you to actually take physical delivery, but we have heard some horror stories of people that have accidentally had to take delivery. So for example, I heard a story one time of someone had to take delivery of 10,000 cattle. When you have to take delivery of that many cattle and you're not expecting it, suddenly you have to store the cattle somewhere and you have to pay these exorbitant fees. And this is real. People have gone bankrupt from having to take delivery and pay these fees. Like I said, your broker will never allow this to happen, but for anyone that gets real advanced and really gets into it and maybe works for a firm, this actually could be a risk that you need to make sure is not happening. Make sure you're just taking cash settlement. This is a really important historical event that happened in 2020. Oil prices went negative. You can see our chart here. Oil prices got down to negative $37. So how does this happen? How does the price of oil go negative? Well, this is the futures market for oil. So in 2020, this was during COVID, there was this huge surplus of oil, and the oil futures were getting near their expiration. But there's already a surplus of oil, and there's nowhere to store more of it. Since there was no place to store the oil, the fees were going to be extreme. I mean, to find another place to store this oil, people were going to be charging these extreme fees. So no one wanted to be holding a long position going into expiration. No one wanted to be the buyer of that oil contract, because once they took delivery of the oil, their fees would be insane, and they could possibly go bankrupt from just from the fees of having to find somewhere to place this oil. And oil futures hit negative $37. People were being paid to take oil. So I remember watching this in 2020. This is a very underrated and an amazing event that happened in history that more people should know about. And I think this really demonstrates the essence of futures. This is really kind of what's going on with futures. If you can understand this event, then I think you would understand futures. So we still have a couple slides left to really grasp the concept of futures. If you're enjoying the video, though, consider liking it. Let YouTube know that this is a good video and it's valuable to people. All right, let's get back to it. So futures are leveraged, which means the profits and losses you can see from it are greater than if you were just trading the underlying. So look at the example, the top right, I have some contract specifications up here. I'm looking at gold. One gold futures contract equals 100 troy ounces. It doesn't equal 1 ounce, it equals 100 troy ounces. So when you're trading a gold futures contract, you're actually trading with the value of 100 troy ounces. So gold futures contract is priced at 2,500 because that's the price of 1 troy ounce. So when we're actually trading gold futures, we are trading it based off of this value. This is what it's priced at. However, the contract controls 100 ounces. So if gold changes by $1, the value of your futures contract changes by $100 because it's controlling 100 ounces. And to trade futures, you have to have a margin account, meaning you have to have a certain amount of money in your account to trade the contract and have leverage. So leverage means you are controlling a greater amount of money than what is actually in your account. And we're going to talk about this more on another slide to really help you understand it. So to trade the gold future, you need 4,950 in your account. And this is what's set by the broker. This is what's set by the CME, the institution that controls the futures. So they set this. They say you need $4,950 in your account to trade a gold futures contract. And remember, one contract controls 100 ounces. So effectively, you control 100 times 2,500 or $250,000 of gold. So with 4,950 in your account, you can trade with $250,000 worth of gold. And this 250,000, that's called the notional value. Notional value is the total amount of what you're actually trading. So I get that this might be a complicated idea for some people. It's kind of difficult to understand at first. When we trade the gold futures, the price we see on the chart is 2,500, and it moves up and down, $1, $2. When it moves up $1, I see the profit in the account as not being $1, but being 100. So for every $1 move, the profit and loss is multiplied by 100. And this is because, once again, we're actually controlling 100 ounces of gold with it. We're not controlling one, we're controlling 100. If we were trading this S&P 500, the E-mini contract, S&P 500, if this moves up $1, how much does the value of our E-mini contract move? It moves by $50 because we're controlling 50 of the S&P 500 index. The initial margin is the amount that you need to have initially in your account. So the 4,950, that's your initial margin. You need to have that much at a minimum to be able to trade one gold futures contract. The maintenance margin is how much you need to keep your account at. Otherwise, they'll close your position. So let's say you buy the gold, and the gold futures is going down, and it goes down enough so that your value of your account goes below 4,500. Then your broker will go ahead and close your account. So if you bought it, they're going to automatically sell it for you, and to ensure that the losses do not grow. So a futures account, a margin account, you put up some money, and really most of the money you're trading with is actually the broker. And they'll give you this wiggle room here, the difference between the initial and the maintenance margin. And so as long as your account stays above that maintenance margin, it's fine. They'll let you trade with their money, and any losses basically come out of your money first. And then once it goes below the maintenance margin, the broker sees the risk as being too large, and they go ahead and close your account. Okay, before you go, stick around for 2 more minutes, and I'm going to show a live trade example on how I actually trade futures. And this will really help cement the idea of futures for you. So continue watching. So this is an example trade of me trading gold. And what I want to point out here, so I had bought at 2712.7. Okay. Now I was saying with gold, for every $1 change equals $100. And you can see that on the above my head, you can see the profit and loss. So if every $1 change equals $100, then every 0.1 change would equal $10. And that's the increment that gold actually moves. It's by 0.1. So for every 0.1 change, my position is changing by $10. And so this is mostly what this channel is for. It's for trading, learning to trade, especially futures. So we do some gold trades. I mostly do E-mini. That's most of what my trades are on. And if you're interested in learning how to trade and want to do things like this, either part-time or full-time, well, consider subscribing. And I have lots of videos that will help out traders go from being beginner to advanced. So if you're interested, like I said, check out some videos. I'm sure they'll be helpful and that you'll like them.